In this video, guys, I want to look at spread betting versus CFD trading. Stay tuned. Hey guys, warm welcome to you. Okay, so you might be saying, hey, what's spread betting? What's CFD trading? I kind of get this, but what's the difference? Which one really should I go down? And now this is really only a question if you're a UK resident. If you're not a UK resident, spread betting is, I don't know any other country actually that's applicable to. So you're probably going to go down the CFD route if that's the way that you're wanting to trade. But if in UK, you can, especially when you look at brokers, because many brokers will offer CFD trading and they'll offer spread betting. You're like, okay, I don't really know the difference. They look pretty similar. And you know what, guys, for all intents and purposes, they're very, very, very similar products. Most of the time they use the same platform. They're very similar in the nature that they're priced. There's so many similarities. It's just personal choice. And some of the main things I've got are here. Some of the main things that might make you choose to trade via a CFD or a spread bet. And there's only, to be honest, there's only a few. There's only really a few. And so things with spread bet and CFD allows you to speculate on the future direction and price of an asset, right? And you load up your account, you do this, and you put some money in, and you kind of can choose whether to go long or short. And with both of those, you can do this. In other words, if you go long, you're speculating on the price of the asset going higher. If you go short, you're speculating on the price of the asset going lower. You can't do this if you buy shares. And so CFDs and spread bet both get a tick in the box for this. Yes, you can go long and you can go short. Great. So as active traders, that's good because you want to be able to speculate on the downside and the upside. All right, stamp duty. So if you're buying in the UK and you're buying shares, you have to pay stamp duty, right? It's one of the things the government's put in. If you're buying a CFD or a spread bet, you do not have to pay any stamp duty because you're not actually buying an asset. Believe it or not, you're buying a contract here and you're placing a bet here with spread and CFD. Okay, neck and neck so far. Right, no capital gains tax. This is where I would say the main reason to spread bet exists. Now, you might not want this, and we'll go touch that in a moment, but if you are, let's just put it, it's a hypothetical person. You are you're working normal hours and you want to kind of do a bit of trading part-time and have a bit of a speculation on some of the direction of some assets or whatever it may be. Now, if you're in that situation, when you're spread betting, you're going to have no capital gains tax to pay. By the way, it's not advice, laws can change, all that other stuff, but at the moment, that's how it's positioned. If you make a bet, because it's wrapped up as in a bet wrapper, then winnings are free of tax. And so you win £1,000, £10,000, £100,000, £50, there's no tax to pay. And so it's very, very simple, there's no tax return to add, etc., etc., etc. CFD trading, however, is different. It is classed as a capital gain. Again, you need to speak to accountants and double check all this kind of stuff. And I'm not here to give you tax advice, but broadly speaking, that's how it's structured. Spread bet is tax-free. CFD, there's a taxable gain to pay if you make money on that trade. So no capital gains tax, yes for spread bet, no for CFD. I want to scoot down to here because this is kind of similar thing. You might say, well, this has got to be a spread bet then, right? Not necessarily, because you might want to be able to offset losses you make in a CFD trade against other gains you've made. Let me kind of explain why you might want to do that. So imagine you've got a share portfolio, okay? You've got a portfolio of shares, and let's say you've got 10 shares in there, 10 different companies you're exposed to. And let's say one of those companies, you think, oh man, I think the next 6 months are going to be awful for this. It's just spiked up massively. I don't want to sell it and crystallize this gain and have to pay stamp duty by selling the shares, and there might be other reasons why, but I want to kind of hedge the position. And so hedging the position would mean going short. Remember we said we can go short on via a CFD. So that in that case, you might kind of sell the same amount of shares via a CFD. So you've got 10,000 shares of this company. You might short 10,000 shares. Now, if that goes lower, then fine, you've made on your hedge, you've lost on your investment, then it's kind of work out in the wash. The gain you made there and the loss you made there is still net zero. You've kind of hedged your position, right? You've done what you wanted to do. If you hadn't hedged, you'd have lost that unrealized gain that you had in your investment. Now, if the price keeps going higher, you're like, okay, I've lost on my CFD short trade. Let's say you lost £10,000 on that, but you've gained it on this. You want to be able to offset that loss from that gain, so it's a true hedge, right? If that goes up by 10,000 in the next 6 months and you've lost 10,000, you're net neutral over those two, so you don't want to be paying tax, right? You don't want to be paying tax on the extra 10 without being able to say, hey, actually, I lost 10 here, so that should offset that. So that's why you might want to pay tax and be able to offset the taxes. If you did it via a spread bet, imagine that. You lost £10,000 on your spread bet, you gained 10,000 there, that's a bet. Tough luck, you can't offset that, you can't have cake and eat it. If you made it, it'd be tax-free, great, but if you're wrong, you can't offset that. You're going to, even though you've lost 10,000 here and you've gained 10,000 here, you're going to still have to pay tax on that 10,000, or whatever the calculation works out to be. And so there are times when you might want to use the fact that it's a taxable product to your advantage. But if you're just speculating, if you're just kind of amateur trader looking to get involved with the markets, then, you know, having that ability to trade without worrying about any capital gains tax is a big plus. So offsetting losses, you can't do it with a spread bet, but you can do it with a CFD. Now, trading on margin, leverage and margin, meaning that, okay, don't go into a massive detail with this now. I've done a whole video on this explaining this concept, but ultimately means that unlike shares, if you've got £10,000 with shares, you can buy £10,000 worth of shares, right? If you have £10,000 in a CFD account or a spread bet account, both those allow you to trade on leverage. Use that as a deposit and as you can control more money. So you might be able to control, let's say, £50,000 or £100,000 worth of assets with that. Now it's a double-edged sword because you're multiplying the profit when it goes in your favor and you're multiplying the loss when it goes against you, but it allows you to leverage your money. So it allows you to make your money work harder with the upsides and downsides that come with that. And so yes, both these products allow you to trade on margin. We'll get both of those, get tick in the box. No commission. Now this depends on the broker, but generally a spread bet is free of commission. And actually that doesn't depend on the broker. The CFD does depend on the broker. Spread bet is free of commission. The price to trade is wrapped up in the spread. You might pay 1 point. So if you're trading £5 a point, you can buy 1 point higher, then you can sell out, then the spread is 1 point. It's going to cost you a fiver to take that trade. If you do £1 a point, it's going to cost you £1. Now, if you're trading an instrument that's very volatile, let's say you're a day trader and that thing's moving 200 or 300 points in a day, paying 1 point is probably not going to be a problem unless you're trading many, many times a day, in which case it add up and is another kind of conversation completely. But the cost to trade is quite low. Same with the CFD. Now, some CFD providers do this slightly differently, where they have a spread plus a commission, or they just have really, really tight spread, or it's generally a really tight spread and plus commission. They generally work out to be give or take about the same to trade in terms of price, but something about the commission and the spread, they're about the same. Some CFD providers just have the spread and just charge you the spread. It depends how they kind of how they present it to you and how they, the commercial way they approach this. But it's just worth looking at terms and conditions. But ultimately, they're pretty similar in the same way in terms of cost most of the time. CFD might be slightly less attractive in that you get to see exactly where your net kind of position is from. So you buy a spread bet, that's the level, that's your break even. If it comes back to that level, you know how much you won or lost. If you're CFD trading, depending on how they report the commission, you don't know really what your commission bill is going to be, so you don't really know where your break even is. You might want to have the simplicity of a spread bet. So I'm going to put on here, no commission on spread bet, you do commission on CFD. Now, one other benefit of a spread bet that I haven't put on here, as opposed to a CFD, is that you can hold your funds in the same currency. So a spread bet allows you to say, hey, I want to trade in pounds, and I'm going to bet, because I'm betting on the direction of this asset, I'm not holding under an asset, I can bet on a US dollar denominated asset, or a euro denominated asset, or a yen denominated asset, but I can bet in pounds because I'm betting on the direction in terms of pips or cents or dollars or whatever it may be, and I can just do £1 per point, £2 a point, whatever it is. If you're trading a CFD contract, you're going to have multiple currencies going at any one time. If you're trading NASDAQ, it's going to be denominated in dollars. If you're trading Lloyd's Bank, it's going to be in pounds, etc., etc. DAX is going to be euros, and you have to do some kind of currency shuffle at some point to bring it back into your base currency. Some providers do that automatically. Some providers give you 3 different or multiple different balances that you convert back. It just depends. Now, you might like that because again, you are kind of getting a pure exposure to what you want in the currency you want. You might prefer the simplicity of having just one currency. It depends on what your goals are, what you're trying to achieve, how kind of activity level you have as a trader, whether you're hedging, whether you're purely speculating, all this type of stuff. So they are very, very similar products. There's some subtle nuances. The key is to find out what's important to you. Is it the tax situation? Is it the simplicity of having a currency? Is it to offset losses? Whatever it may be. Is it the range of instruments? We're checking brokers. Some brokers offer a few more different instruments with CFD versus spread bet. And it's also worth noting here, the final point, for some traders, direct market access is applicable for CFD but not for spread bet. So what does that actually mean? That basically means that some brokers allow you to put your orders directly into the exchange. So you might say, hey, I want to trade Vodafone, I want to trade it via a CFD. You might want to trade via the order book. Now, if you're very active, this is not something that everyone's going to want to do, but if you're an active trader, you can basically kind of try and work an order on the bid and save that spread and play around actually in the order book. And as it comes back and gets wrapped as a CFD for your reporting, but it just allows you that little bit of extra nuance, that direct market access. Again, this is such a small section of traders who want this, but you can't get that with a spread bet. You can only get that with a CFD. And again, not all brokers provide it. Again, very small number of people who would actually want that and require that, but it's there. So there you go, guys. Spread betting versus CFD trading. Like I say, they're very, very similar. Most people in the UK, I don't know this for certain, but let's call an amateur trader who is speculating on the market direction for a few things. A spread betting account is going to be absolutely fine for them. If they make some money, it goes in their pocket, they don't have to worry about tax. The simplicity of one currency, very easy to understand once you get going. Again, open a demo account, understand the risks of trading, all that other stuff. But spread bet is probably how the majority of people go. CFD, again, very, very similar. There's some nuances there. You're going to have to report some of your taxes. You're going to have to understand the difference of the currency exposure. And generally, I find that CFD accounts tend to be larger accounts. In other words, spread bet, you can go very, very small position sizes and play around with, £10, £20, £50, £100, that kind of type of thing. When you go into a CFD, position sizes are a little bit larger. You're going to need a little more margin. So your profit and loss in your positions are generally going to be. That's a broad generalization. They're not all the same, but that's just from my experience. I see the CFD accounts a little bit higher price per trade. Spread bet account is a little bit less, and so you can kind of still trade bigger size if you want. You've got the ability to trade small size if you want to. All right, spread bet versus CFD. Hope that's helped. Bye bye.